So let me start by asking you, have you been making any changes to your portfolio? Have you been increasing your exposure to some equities?
We moved underweight in equities really before the summer, particularly in financials, but we've held on to our basic industries, chemicals and some of the more cyclical areas as well, particularly industrials. So we've held on to those, and some have been sold off quite heavily now, and we're going back in.
So you say you like companies with low but steady growth, as you say, tobaccos, utilities, pharmaceuticals. You're saying they're priced attractively at the moment, but give me your top pick.
Well, we've certainly been adding to tobaccos, pharmas like Roche and Glaxo, but there's an opportunity now with some of the stocks that have come back, some of the industrials we like Weir Group, Petrofac, Croda in particular, and some of the other chemicals businesses we like.
Okay, so talk to me then about specifically Petrofac, oil and gas facilities provider. It's had a strong start to 2011, and actually if you look at shares in Petrofac and indeed its competitors, Amet, Wood Group, they've all set record highs this year. What's driving this?
Well, good orders, a lot more drilling and exploration, so the end markets that they serve in oil exploration have been quite buoyant, and particularly for the expertise they have, the techniques they have. So the order book, the backlog really on Petrofac has been growing quite strongly, really faster than they can deliver. And that, I think, bodes quite well if there's a downturn. I think it's got quite a lot of backlog to work through and should be quite resilient in any slowdown in global growth.
Okay, according to an August 8 note, though, by Bank of America, the note said oil producers will spend more on services as long as the commodity stays above $80 a barrel. And I suppose the risk is that with a slowing global economy, we're not going to stay in this high oil price environment, and it would therefore have an adverse effect on the likes of Petrofac.
I think to a small extent it would, but as I say, the backlog is quite strong, so I think it had a lot of orders to work through over the next couple of years. And I think a lot of drilling is getting increasingly technologically challenged in deeper waters and new areas. So I think the expertise it has, and particularly in the expertise it has in getting the best extraction out of existing fields, I think that's still going to be needed, whether oil's $80 or $120. I personally think oil will stay reasonably firm, even as the global economy slows.
All right, so what about Weir Group? You mentioned that company as well. This is the world's biggest maker of pumps for the mining industry. Why do you like this company so much? What is it specifically that makes it so attractive?
Well, it's not valued as highly as others that are serving the same markets, partly because of its history. It's translated over the years from more mundane engineering businesses into serving these faster growing emerging markets and drilling and exploration areas. So it's not been quite accorded the rating it deserves for the profits growth it's had. But it has a very good profits growth record, and the rating now is really quite low, so it'll be coming down below 10 times for a couple of years' time. And I think this would make it an attractive acquisition for someone else, but also I think it deserves a re-rating even from where it is just now.
And you also like Croda International. Now, this is a cosmetics ingredients maker, and I'm wondering, are companies in this industry group somewhat vulnerable to volatility in raw material costs, which we've been seeing over the past few months?
Yes, Croda has been able to pass this on. I think the extent of price rises it's had may be difficult to maintain, so I'm not sure it will continually be able to pass it on. But Croda, through the last two cycles, didn't see the recession really at all. It managed, in the downturn we saw in 2008, managed to increase its profits and dividends. So it's proved itself remarkably resilient, mainly because it's made up of a collection of fragmented niche businesses, and that gives it a lot of protection. So I think it will have some impact from the cycle, but it's been able to come through cycles without
Colin,
actually seeing a big downturn.
If I could get an idea of your broader strategy, your approach, if you like, do you look for strong dividends and low valuations? Do you typically buy in the dips after a major sell-off?
I think just now we haven't seen the full extent of this sell-off, so we are still maintaining reasonably high cash levels relative to what we normally have, and I think the impact of slower global growth is yet to be factored in analysts' forecasts. So we're just seeing some of that coming down. We're seeing companies reporting some good figures, but it doesn't really tell us a lot about the immediate future. And I do think the financial crisis, particularly the Eurozone, is going to be very difficult to resolve quickly. So I think there would be better opportunities between now and the year end to put some of that money to work.
All right, thanks very much indeed. Colin McLean, SVM Asset Management. Great to get your thoughts on where you're putting your money at the moment.